Mike Harris. Joe, I'll start with you. You're bullish for 2013, but here come Q4 earnings. It's not so much that we're worried about what the numbers would show. In fact, a good chunk, a good percentage of the 27 or so S&P companies that have reported have actually beat. It's the downward revisions for the current quarter that worry us. Does that worry you?
Yeah, that's a concern. I think when you look at the analyst expectations, one thing you need to remember as well, if you look back in October, analysts predicted about a 9% growth rate this quarter. Fast forward to today, what are we seeing? About 2.5%. So those expectations have been brought down quite a bit as we move into this earnings season. And we also saw a lot of downward revisions as well early on in the earnings season. I still think it's a little early, but overall, I think those low expectations could be a good catalyst because it sets the bar that much lower to meet or beat those expectations, and I think that could be a good catalyst in the next few months.
Michael, we talked about all these billions of dollars flowing back into the market. A lot of it has to do with changes in terms of guarantee for money market funds, et cetera. But there is a lot of optimism about the equity market. Maybe it's simply because, as Liz was saying before, there's no place else to go, no place that you can get a return on except equities. Some people are concerned about this, though. They're kind of spooked by all the bullishness. Are they just too pessimistic or what?
Well, we're a momentum-based trading shop, so we're happy to have more money coming into the markets. Interestingly enough, we've been following an uptrend in U.S., European, and Asian equities for the last few months. And certainly it was nice when everybody else was panicking about the fiscal cliff and getting out of the markets that it gave us more opportunity to add to our long position. And certainly with more investors coming into the market here in January, it's only going to continue to drive momentum higher and push markets up to that 5-year high.
Okay. You know what? Everybody wants to know, whatever your perspective, where do you put the money? And Joe, I want to start with you. I mean, where do you find the most compelling investments for the retail investor out there?
I think when you're looking at the sector, or the economy as a whole, the sectors that stand out to me are going to be housing sector and consumer discretionary. Sort of falls into the same thing when we look at the broad market. These sectors have performed quite well, and despite that, the short sellers continue to target them. We see a lot of bearish bets from option speculators, and analysts just haven't really bought into those. So we don't always want to focus on low prices, but low expectations. And for those reasons, we think those are two sectors you want to have some money in for 2013.
Okay, so you believe that housing still has gas because they've had a beautiful run up here for many of the names and the sort of derivative plays on this.
Yeah, they definitely have. But I think when on the shorter term of the past 52 weeks, they potentially look a little overbought. When you take a step back and look at a longer term chart, most of those are still about half of their all-time high. You couple that with the fact, like I said, there's just a lot of skepticism towards housing. A lot of people, like you said, mentioned too far, too fast. We just think whenever there's that doubt on the sidelines, it represents a lot of money that has yet to be put to work. You talked about the inflows into equity funds this week. We think perhaps that could just be the start of a little bit of the acceptance phase where some of that money starts to come into this market and really push those prices higher.
I want to stick with Joe for a second. Michael, I haven't forgotten about you, believe it, but I mentioned Netflix earlier on with Lauren Simonetti. I know, Joe, you're a big fan of Netflix, but it's now in the triple digits. It's over $100 a share. People are worrying that with all the competition out there, it's on a sugar high right now. What do you think?
Yeah, that's absolutely right. It has had a pretty good run, but that's another one. You take a look at the longer-term chart. It's nowhere near its all-time highs like you might see some of the other consumer discretionary names. But that's one we just look at. A lot of shorts targeting that name, a lot of analysts, just a lot of doubt toward Netflix in general. And we think that bar's been set so low for Netflix that it doesn't take much for it to beat those.
Michael, back to the general picture. Some folks are saying what we're heading towards is one of these big dumps of stocks, dumps of equities in the springtime. You don't see that coming?
Well, we follow trends. We don't predict them, so I can't say that I see it coming. But interestingly enough, you know, one of the benefits of systematic managed futures is that we don't have a bias to be long or short. So if we see the dump happen in the spring, our models will shift from being long and start to follow the downtrend, and in many ways provide some of the portfolio protection that investors need because we are seeing investors move back into equities in 2013.
But you don't like precious metals, Mike. We just saw that platinum made a very nice move today. Is there a base metal you prefer?
Certainly on the base metal side, we've seen more of a downward trend recently, and we've had short positions in those markets. In precious metals, it's not that we don't like them. There's been a nice trend to the upside from a long-term basis, but certainly we've seen a pullback in recent weeks. So our shorter-term models have covered a lot of our long positions.
Could you jump in and say that copper on a recovering economy might do better?
I mean, right now we're following a downtrend, but it's absolutely possible that if we start to see the emerging markets, the China slow landing story is still out there, and whether or not we see a pickup there, base metals may come back into fruition for sure.
Cool. Joe, would you go to ETFs if you're generally bullish about what's happening in equities, but you don't want to focus on individual stocks, even though you're big on Netflix, Expedia, and Lululemon? What about going for the ETFs, and which ones would you prefer?
Sure. I think for the common investor, ETFs are a good way, especially as we head into the earnings season. There's a lot of event risk when it comes to individual earnings plays. For home builders, you can look at the XHB, the home builders spider, and then even the XRTs one. We've heard a lot about the consumer, but the retail names have been doing incredibly well, so XRT for retail would be a good play as well.
Joe Bell, Mike Harris, gentlemen, great stuff. Thanks very much. Have a good weekend.
Thanks for having us.
Thank you.